Good evening, ladies and gentlemen. Welcome to Reference Point. I'm your host, Dave Cokerhook. And this evening, I'm pleased to have with me a guest that's been on Reference Point several times, and I'm real excited to have him back here. It's Narbik Karamian with BeneGroup. And BeneGroup, as the audience might remember, is a mortgage brokerage firm and real estate firm. And we're here today to talk about how things are looking now at the beginning of 2014, because there's been some interesting shifts and changes both in what's happening in the real estate market, but also some laws that have provisions that have come into effect early January that are going to impact things for people out there. So, Narbik, I'm excited to have you back. Thank you for being here, and I'm looking forward to this conversation.
Well, thank you, Dave. It's great to be here. I remember the first time I was here was August of 2007, which was the beginning of the financial crisis. And we were able to touch on certain topics that really hadn't happened, and we saw it take effect throughout the years. And now we're here looking back at the aftermath and how everything is recovering again. So,
right. And I think that's a great place to start, talking about how things are recovering. Because when we look at the housing market today, here at the beginning of 2014, and compare it to even, say, 2-3 years ago, 2011, 2012, when we were really still in the throes of the recession, or just starting to come out of it, how have things changed with respect to the housing market?
Well, a lot has changed. We've gone through a lot of cycles between the 2007 all the way through here. And 2011-12 was actually during the period where we were actually coming out of the real estate crisis. Foreclosures were still high, home values were down, but they were starting to pick up as there was a demand being created for real estate, and that was one of the contributing factors for expediting the process of the recovery.
When you say the demand was being created, was that because the economy was improving, or were we getting overseas investors coming in and saying, hey, things are way low, so let's go in and buy some property in the States?
Well, a combination of both. A big contributing factor was foreign investors coming to the United States to buy property, which we all know how cheap it was back then,
right,
with interest rates being so low as well. But there was also the period between 2011 and 2012 where, especially here in the Bay Area, we noticed companies starting to hire again, and I guess the circumstances were right for people to either refinance or buy new property, which I'm sure the ones who did can look back and see what a great thing they did with all the appreciations that we're seeing nowadays.
Well, and let's talk about that for just a moment, Narbik, before we get into some other really interesting items that you and I had chatted about prior to the show. But our situation here, we're in Northern California, and we have a unique scenario here in our area. Silicon Valley's here. We got a lot of technology activity. We're a major port with the Port of Oakland, so there's a lot of import-export activity that goes on in Northern California. But when you look at the rest of the country, because there's folks out here in our viewing audience that are either from other parts of the country, have family in other parts of the country, or own property in other parts of the country, or maybe looking to do so. Do you have any information regarding how things compare here to various other places across the states?
Well, the only thing that's very interesting to me is when you compare statistics with the rest of the country is, California is usually the first to undergo changes in real estate market when things happen, but we're also the first to recover from it. And I've noticed, just looking at our neighboring states like Nevada, and Arizona, they all followed suit as soon as the financial crisis took place in California. Within a year or so, I'm sure we all read somewhere in the paper or in the news where properties in Las Vegas were depreciating, and Arizona followed suit.
They just fell through the bottom.
Right, and then California recovered pretty quickly within a couple of years, while the other states are starting to recover, and some are still in the midst of the initial phases of their recovery.
Right.
But also the amount of recovery and the appreciation we notice here in California is also very unique compared to the rest of the country on a grander scale. So said, we notice larger appreciations here than we do.
Does that would seem to be fairly consistent across the boards for our Northern California or even throughout the state in terms of homeowners starting to see some appreciation. Current economic news talks about the what job creations there are or aren't and that sort of thing. And we're still seeing the disparity relative to wages and things. But the fact that that people's property is appreciating has got to be a tremendous help to them.
Definitely.
Let's talk a little bit, sort of coming out of that, the fact that there are still a goodly amount of foreclosure activity that's going on. And the government had put a couple of programs into place. And one of our previous shows, actually a couple of our previous shows, we talked about what was called HARP, and I don't remember what the acronym stands for, but it
was the Home Affordable Refinance Program.
Home Affordable Refinance Program. Okay, and so that type of activity, that program is still in place, is it not?
It is. Actually, it's one of the most popular products that the government came up with. I remember in one of your shows we exclusively discussed this particular product, and I remember saying that from all these new laws and regulations the government came up with, this was the most efficient.
Right.
And it was just a tremendous move by the government to help people who were underwater as far as negative equity went, or not having enough equity to refinance.
Right.
And it's still ongoing, and it's actually taking a large chunk of the refinance market nowadays, going to HARP.
The refinance market. Because I remember that another thing that was really, a very aggressive refinance activity as the mortgage lending rates were going down every few weeks, it seemed like, for a while there, back in 2012, 2013, well, 11 and 12 for sure. Stuff was going down and people would refinance often because they had a better opportunity. And so did that tie into HARP? I mean, was the HARP program focused on those folks who were underwater, or could anyone take advantage of the refinance activity?
Right. No, HARP was exclusively for people who wanted to refinance but couldn't, only because of the fact that there wasn't enough equity for them to refinance.
Okay.
So that was the exclusivity of HARP. But of course, the low interest rates contributed to the fact that people now who could qualify for HARP could actually take advantage of lower interest rates as well.
Right.
Because these were primarily homeowners who had gotten their loans back in the 2007s, 2008s, before the crash,
right,
and had paid a large amount for the properties that they had purchased. So with interest rates back then being in the 6s and 6.5, so being able to take advantage of low interest rates on top of being able to refinance despite the fact that there was negative equity was a big move that the government set forth.
And then there were those people for whom the negative equity situation was not a major problem, but the interest rates were going down anyway. So they were in a position where they could take advantage of that activity too. Now, where is that today? Is that refinance engine still as aggressive now as it was a couple of years ago?
Not as much. On the graph we have, we'll hopefully get a chance to see it. Interest rates have gone up by almost a full % compared to last June.
Which graph was that? Was that the one, the Fred graph, or the other?
No,
the other graph. Okay, maybe we can put that one up on the screen, and we'll have a copy here, and you can tell us a little bit about what this means.
So this graph actually shows how interest rates have been, behaving from April of last year all the way to the current.
Okay.
And the blue shaded area there are two types of loans that the government, allows. One of them are loans that do not exceed $417,000,
right,
which is called the government conforming loans. And there are loans that start from $417,001 all the way to $625,000, and that's called the high balance conforming limit, which is the red line on the graph. But as you can see, they're pretty much similar in the trend they follow.
Yes.
But looking at May of last year, and these are all on 30-year fixed loans, which is one of the most common loan products available or out there. Going back to mid-May, you notice that the interest rates were somewhere around 3.375 on the conforming, and again about 3.5% for the high balance conforming. Right. And as soon as the government announced, or the Federal Reserve announced, that they were going to wind down on the quantitative easing,
oh, right, yes,
that's when it triggered the message that the government's not going to stimulate the economy as much as it had in the past. and therefore this triggered a hike in interest rates. And as you can see, it went as high as 4.5% towards the middle of June, and then the drops you see, the little drops there, are all contributing to shocks in the economy, be it domestic or foreign.
Okay.
And we had some that happened outside in the Middle East and whatnot.
Right.
But as you can see, the trend has pretty much stabilized, where interest rates are now in the low to mid 4% rate.
Okay. And that's still pretty good relative to what it was 10 years ago.
Well, anything below 5% is historical.
Yes. Okay.
So,
But with this being where it is now, is that one of the I'm trying to figure out how to appropriately phrase the question. It doesn't seem that the level of activity relative to refinancing to take advantage of interest rates is as high as it was a couple of years ago. It's not.
That's
it's
correct.
Still going on, but it isn't quite as okay.
So the homeowners who were able to take advantage of the real low interest rates did so up until maybe May, June of last year.
Okay.
What the trend is now on the refinance aspect is primarily towards HARP, who are homeowners who still have the 6.5–7% interest rates, where they're at a point where they have equity now.
And they couldn't qualify for anything else, which is
Right.
why they had to stick where they were, because they couldn't get a refinance
Right.
structure by virtue of their credit situation.
Exactly.
Okay. So you touched on it a little bit, Narbik, when we were looking at that interest rate graph and the impact of our policies, Federal Reserve policies and stuff like that. We've got a new Fed chairman. What seems to be your thoughts relative to the direction that our new Fed chairman has been talking about, and what that might mean to the interest rate scenario?
Well, I think Ms. Yellen's agenda, as far as the federal chair, is not going to be too far off from what we saw from Mr. Bernanke. So therefore, I think we're going to follow the same trend. One of the biggest things that Mr. Bernanke did was actually let the public and let the market know ahead of time what decisions the Fed was going to make. And that was one of the reasons where the market didn't really fluctuate.
Is that an unusual thing?
It is. It is. Prior to that, the Fed would make their announcement, and that would be pretty much whether the shock or the no shock to the economy. But ever since the crisis, one of the things that became known was the Fed will let the market know what's coming.
Okay.
And I think that gives them enough time to adjust or to prepare themselves for what is to come. So the fluctuations haven't been much based on what the Fed announced.
Does that also have a positive impact on international markets?
It does. It does. The global market pretty much feeds off of the United States market, so the U.S. economy. So, and as you can see, as we're getting better now, the developing countries like Brazil and India and those countries are starting to notice that investors are pulling out and coming back and investing in the United States. So there's a lot of stability that needs to take place until the global market stabilizes again. And one of the reasons interest rates, we noticed a slight drop in interest rates in early February was because of the I guess, what's happening in the developing countries and the risk to certain inflationary measures there. So.
Got it, which is a reason for people to start bringing their money, because when bringing their money back to the United States, because it was an interesting thing. You mentioned it earlier, that when at the height of the recession, when property values were so cheap and the dollar was so cheap, a lot of foreign investors were coming to the United States and buying properties and investing here right. because they could get more for the cash that they had. But that's this is an economic balancing act. I mean, or more like a pendulum, I guess. It swings one way and then it swings back the other, and there's no way of knowing exactly where it's going to go, and it's real hard to predict because almost anything can cause blips on the radar. Right. I would imagine that that superstorm in the Philippines right. Had some impact. All these sorts of things will have an impact.
That also shows how volatile the economy is. When the economy fluctuates the way it has in the past several years due to circumstances like natural disaster, that shows how fragile the economy is. It shouldn't be like that, or the effects should not be as significant as we've been noticing here. So, and hopefully as we move forward and as we come out of the woods for of what we've been facing since 2007's financial crisis, I think we're going to notice less of impacts of such circumstances in the U.S. economy.
The recovery has been slow, relatively steady, but still very slow. The increase in the job market has been modest, I guess. Does that, let me rephrase this, to what degree does that have an impact on the real estate market and the mortgage situation?
Well, it does play a role in what the interest rates, in what direction the interest rates move. Obviously, one of the reasons where interest rates stayed so low was because of the unemployment numbers. And by having high unemployment numbers, the government was forced to put in or to add further quantitative easing into the economy. I think we all know that they were buying, the Fed was buying $85 billion worth of treasuries every month,
right,
to just show that there is a big demand for U.S. treasuries, even though it was artificially being stimulated,
right,
allowing interest rates to stay low. Because one of the biggest contributing factors that decide mortgage rates are what the 10-year treasury is, what the 10-year treasury is.
Oh.
And so if we take a closed environment, for example, if there are a lot of 10-year treasuries being bought,
right,
then the demand for customers drops because they already have the customers they need to sell the 10-year.
Sure.
So therefore, they do not need to give a higher return on the investment or the yield on that, for that matter. So therefore, the yield drops because they already are selling as much treasuries as they want. And the lower the yield, the lower the mortgage rates drop. So that's been the balancing act. And what we're noticing now is as the government's pulling out of artificially stimulating the economy, I think we've read twice that they've decided to cut down on the stimulus by $10 billion each time. What they're trying to do is pave the way for foreign investments to come and take over U.S. treasuries and continue buying them. So therefore, it'll allow the economy to stabilize and go back to the way it's supposed to function.
So it sounds like they're trying to regulate it a little bit. They're trying to just do little tweaks here. They're not trying to control it completely the way like the Chinese economy might be, but they're trying to make sure that we don't have any major obstacles in the way of recovery. Well, that's great, but let's now talk about how some of these things are going to directly impact people who are looking to either buy a home or refinance or sell. Because there were some things from the DoddFrank bill, which was, I can't remember its official name, but there were some provisions of that started to take effect here at the beginning of 2014 and tied to this, what we call it, qualified mortgages and non-qualified mortgages and stuff like that. And I want to talk about that now because I think this is a real meat that's going to impact the new
things that are happening. It actually it took effect January 10th of 2014. And what QM or qualified mortgage is all about pretty much is what the government's trying to set as the standard for residential lending guidelines to make sure that the economy does not go through the frenzy we did back in 2007, 2008, which led to the financial crisis.
In terms of the aggressive...
In terms of the leniency there was there.
Oh, okay.
So what they've done is they've set certain regulations, and these regulations are really not much different from what we've been seeing up until now, because we've already seen how tight the lending environment is, how strict the banks are, and how strict Fannie Mae and Freddie Mac are. But what they've done now is set these guidelines straight and said that, you know what, we're going to make it slightly stricter. And these loans that fall within these guidelines will allow Fannie Mae and Freddie Mac to securitize them and to continue doing what they've been doing since 2007.
Fannie and Freddie have been buying virtually all the mortgages over the last several years. Is that correct?
That's correct. And the reason behind that was there were no other investors who were willing to buy U.S. mortgage-backed securities after the crisis we went through. So by issuing the QM guidelines, now for the first time, the government is also allowing private investors to come and lend based on their premise, based on their, discretion. and they can set their own guidelines, which is called non-QM. And this is the first time this thing is happening after the 2007 crisis, where the private sector is now allowed to come and introduce new loan products at their own discretion, at their own risk.
So the private sector, meaning the banking community or whoever has the capital in that's interested in providing that capital into a mortgage situation.
Exactly, and turning around immediately and selling it as a mortgage-backed security through the private sector.
So why does that have a positive impact for the consumer?
Well, up until now, pretty much the majority of the loans that were approved were following Fannie Mae guidelines. So whether you were within Fannie Mae guidelines or you were out, if you were out of the Fannie Mae guidelines, you would not qualify for a loan.
So nobody was going to lend you money.
Right, and that's why
there wasn't anybody else.
Right,
okay.
And that's why it was very straightforward. You would either qualify or you wouldn't qualify, and we know how difficult it was.
And rates were what rates were? The rates were the
same?
The
rates were phenomenally low, but tapping into these rates and qualifying for these rates was a story of its own.
But it wasn't like the rates were fluctuating.
No, they were just on a tad bit. The consumer wouldn't see it in the front, in the consumer side. But now the fact that the government is opening the channel for private investors to come and lend on their own, with their own guidelines, might create some leniency in the lending environment, allowing people who did not qualify based on Fannie Mae or Freddie Mac guidelines to qualify through private investment.
Can you give me a specific example of how that might work?
Exactly. Well, we know there are three main requirements to qualify for a home loan these days. One is the credit score, which I always call it the triangle.
Right.
Okay, the first part of the triangle being the credit score, which we know when the crisis started, the credit score requirements were in the 700s. Gradually, as things improved, the credit score requirements have come down to like 650, 660. The other requirement is equity. Either if you're refinancing, you have to have at least 20% equity in your house to qualify, or if you're buying a house, you need to have a certain down payment to qualify. And the third important aspect to qualify for a loan is what we call the debt to income ratio. You must have income, and you're allowed, up until now, you've been allowed to use 45% of your gross income towards your new mortgage payment, property tax, insurance, and any other liability that appears on your credit report.
Car payment,
anything
whatever.
on the credit report. So one of the changes in QM is this 43%, which used to be 50% back in the days, has dropped now down to 43% from 45%.
Okay.
It doesn't seem much, but that takes away about 18% of the population who's planning on buying homes. That's an 18% drop in people who will qualify.
Moving it down to 43 from 45 gives another 18% of people the opportunity. Takes away
18% because because you need so up until now if you could use 45%.
You could use 45%. Now it's 43%.
Exactly.
So got it.
What that does is the government says, here are my guidelines. But if there are any investors out there who want to change this 43% to 50%, at their discretion, they're allowed to do so. It's going to be their loan product.
Yeah, I'm not going to buy it. Fannie or Freddie won't take it. You're on your own.
Right. They're going to buy it, they're going to keep it, and they're going to service it. And as we see the economy improve, there's a big possibility that the private sector might be able to bundle these as their own mortgage-backed securities and sell them overseas without the Fannie Mae and Freddie Mac.
So why is that a good thing for the private sector to do?
Well, they're getting they're pretty much getting their foot back into the business. Up until now, the private sector was not much involved in the lending world, mortgage world, because of all the lawsuits that existed. I'm sure every now and then we would see in the newspaper where the banks and the government had some conflicts as far as past mortgages. But allowing the private sector to come in will actually allow the government, or Fannie Mae and Freddie Mac for that matter, to slowly, gradually exit the industry and let the economy go back on its own. And I have to say, we know the government lent $117 billion to Fannie Mae, and they've been able to pretty much repay all of that back. So they're not doing that bad.
That's good. Well, that's interesting because what it states is that there may be some advantages to the consumer to be looking at some of the. Now, are there private lenders? When you say private lenders, I'm thinking Wells Fargo, Bank of America, Citicorp, whomever. Are they beginning to actually participate in this sort of thing?
They are. Slowly but surely they are. And we're noticing more different products other than what Fannie and Freddie have to offer are coming out. The one thing I would encourage the consumers to do is, if up until now, whether you went to Wells Fargo or Bank of America and you applied for a loan, they all followed pretty much Fannie and Freddie guidelines. And the interest rate they published was very close to what Fannie and Freddie had, with a slightly increase depending on the profit margin.
Right.
But with the way the market is now diversifying, by new products coming out, I highly encourage consumers to shop for interest rate, because we might see different interest rates with different products. And
you had said something, I think, to me earlier about the probability, or maybe the actuality, that one of the things that banks are looking at now is the relationship, and to offer reasons for a good customer to stay with them. And so this shift in the regulatory structure might offer the opportunity for a good client of a bank to have a little bit of leverage to see if they can get some things in order for them to keep them as a customer.
Definitely, that's definitely a possibility, and we notice that here and there. But ultimately, there's a certain profit margin that nobody is going to be willing to go under.
True.
Right? Especially if now, let's say, instead of having Fannie Mae or Freddie Mac as your main investor, now having the private sector into the picture, where they have a certain expectations for their return on their investment. So it's a big possibility. Again, we're at a point where every bank's trying to attract good clients,
right?
And therefore, one of the things that may not be a bad idea is for the consumer to actually discuss these with their brokers, if they have brokers, because the brokers have access to a lot of these banks.
They'll talk to a bunch of people.
Right.
So this is really cool. So we've reached the end point of our conversation here, Narbik. Again, this time goes by so quickly, but I think the key point here is that as much the changes that have occurred in the environment for mortgage lending in the last even month and a half have created opportunities for the public that they might not otherwise have had, because things are now improving.
Right.
Is that a fair statement?
That's a very
fair statement. Narbik, thanks for being here. I'm thrilled to have you back on the show. And ladies and gentlemen, thank you for watching us here at Reference Point. Don't forget to send those queries regarding this show or any other show to us at info@referencepointtv.com. And we'll see you next time on Reference Point.